If you want to understand how the global financial system nearly collapsed in 2008, you must begin not with a single villain or a single mistake, but with a long season of confidence, quiet, cumulative, and ultimately corrosive. The crisis did not arrive like a thunderbolt. It crept in disguised as prosperity, innovation, and stability. By the mid-2000s, the world believed it had learned the lessons of history. Central banks had mastered inflation. Financial engineering had tamed risk. Housing prices, we were told, never fell nationwide. And the scars of the Great Depression and the dot-com crash were treated not as warnings, but as proof that modern finance had evolved beyond catastrophe. This belief that the system was safer precisely because it was more complex would prove to be its most dangerous illusion. In the years following the dot-com collapse, policymakers faced a familiar fear: recession turning into deflation. To prevent that fate, interest rates were pushed lower and kept there longer than ever before. Credit became cheap, abundant, almost casual. Money flowed easily through banks, shadow banks, and markets hungry for yield. Home ownership was encouraged not just as an economic activity, but as a social good, a cornerstone of the American dream. Mortgages were no longer simply loans. They were instruments of policy aspiration, and profit rolled into one. The housing market responded exactly as incentives demanded. Prices rose steadily, then rapidly. Construction boomed. Home equity became an ATM for consumption. Borrowers refinanced again and again, confident that rising prices would rescue them from any future strain. And lenders convinced they had found a way to eliminate risk-loosened standards with astonishing speed. Documentation weakened. Down payments shrank. Subprime loans, once confined to the margins, moved into the center of the market. Creditworthiness was no longer about ability to pay. It was about the assumption that prices would keep rising. But the real transformation occurred not on Main Street, but on Wall Street. Mortgages once held by banks that knew their borrowers were now sliced, bundled, and sold into global markets. Securitization promised diversification. Risk, we were told, could be distributed so widely that it effectively disappeared. Mortgage-backed securities became the raw material of a vast financial machine. Collateralized debt obligations stacked layers of debt upon layers of optimism. Credit default swaps insured against failure, creating the comforting illusion that losses were impossible. And at every step, fees were collected, incentives aligned toward volume rather than quality. Rating agencies, entrusted as guardians of objectivity, stamped these structures with AAA labels, often based on models that assumed housing downturns were regional, never national. Investors around the world, pension funds, insurers, sovereign wealth funds, purchased these products not because they fully understood them, but because they trusted the system that produced them. Trust, once again, became the invisible currency underwriting the entire structure. Banks themselves transformed under the weight of this new world. Traditional lending gave way to trading. Balance sheets expanded through leverage that would have horrified earlier generations. Institutions borrowed short-term to fund long-term illiquid assets, confident that markets would always provide liquidity. The shadow banking system, investment banks, money market funds, structured investment vehicles grew enormous, powerful, and largely unregulated. It looked like banking behaved like banking, but lacked the safeguards that made banking survivable in a crisis. And then there was belief, the quiet consensus that stitched all these pieces together. Regulators believed markets were self-correcting. Executives believed risk models captured reality. Investors believed diversification was protection. Homeowners believed prices would rise forever. Each belief reinforced the next. The system did not need fraud to fail. It needed only collective certainty. By 2006, the first hairline fractures appeared. Housing prices leveled off. Adjustable-rate mortgages reset at higher rates. Defaults began creeping upward. At first, these were dismissed as localized problems contained as one famous phrase assured. But containment requires boundaries, and this system had none. The same mortgage-backed securities sat on balance sheets across continents. Losses in one corner echoed everywhere. As defaults rose, the models broke. Correlations spiked. Assets once considered independent fell together. Liquidity so abundant in good times evaporated under stress. Institutions no longer trusted each other's balance sheets. Interbank lending slowed. Repo markets tightened. The machinery of modern finance, built for speed and efficiency, proved fragile when confronted with fear. The summer of 2007 marked the turning point. Funds collapsed. Banks quietly sought emergency support. Central banks injected liquidity in unprecedented volumes, hoping to calm markets without revealing the depth of the problem. But by 2008, the illusion could no longer be sustained. Bear Stearns fell in March, rescued through an extraordinary intervention. Confidence wavered. Yet the belief persisted that the system could absorb another shock. It could not. In September 2008, Lehman Brothers failed an event that shattered the final illusion of safety. When Lehman collapsed, it was not merely the failure of a firm, it was the failure of trust. Markets froze. Money market funds broke the buck. Credit markets seized. Trade financing stalled. The global economy stood on the brink of cardiac arrest. For the first time since the 1930s, policymakers confronted the possibility of systemic collapse, not theoretical, but immediate. Standing at that precipice, governments and central banks were forced to abandon decades of orthodoxy. Bailouts, guarantees, emergency lending facilities, tools once considered unthinkable, became necessities overnight. The question was no longer about moral hazard or market discipline, but about survival. And as the rescue unfolded, a deeper reckoning began to take shape, one that would force the world to confront how modern finance had drifted so far from its original purpose, how incentives had warped behavior, and how complexity had obscured fragility until it was almost too late. A reckoning that would reshape regulation politics and public trust for a generation. As the crisis spread from Wall Street to Main Street, from banks to households, from financial panic to economic collapse, revealing consequences that went far beyond balance sheets and stock prices. Consequences that would soon make it clear that the true cost of the crisis was not measured in billions or trillions, but in livelihood's legitimacy and the fragile bond between finance and society itself, a realization that would only deepen as the world began to absorb the shockwaves of collapse, realizing that the crisis was not confined to trading floors or balance sheets, but was about to spill into everyday life with devastating force. What followed the fall of Lehman Brothers was not merely a recession, but a synchronized global contraction, an event so vast that it tested the legitimacy of capitalism itself. As credit froze, businesses large and small found themselves unable to finance operations. Payrolls were cut, investment vanished, international trade collapsed at a speed unseen since the Great Depression. Factories shut their gates. Ports slowed to a crawl. In households across the world, the abstract language of derivatives suddenly translated into something brutally concrete: lost jobs, foreclosed homes, evaporated savings. The financial crisis metastasized into an economic crisis and then into a social one. Governments reacted with a mix of urgency and improvisation. In the United States, the Treasury and the Federal Reserve unleashed rescue programs of historic scale. Troubled asset relief program funds recapitalized banks. Emergency lending facilities propped up money markets. Interest rates were slashed to zero. Central banks crossed boundaries once considered sacrosanct, buying assets outright and expanding balance sheets into uncharted territory. These actions were not born of confidence, but of fear, the fear that hesitation would allow the system to collapse entirely. Europe faced its own reckoning. Banks that had loaded up on U.S. mortgage securities now teetered. Governments guaranteed deposits, nationalized institutions, and absorbed losses that would soon strain public finances. What began as a private sector crisis mutated into a sovereign debt crisis. Greece, Ireland, Portugal, Spain, nations once bound together by a common currency, found themselves trapped by debt they could not devalue away. Austerity followed. Social unrest followed austerity. The political fabric of Europe frayed as citizens questioned who exactly the system was designed to protect. And beneath these policy responses lay a deeper wound: trust. Trust in banks that had claimed sophistication while courting disaster. Trust in regulators who had believed markets could police themselves. Trust in economists whose models failed to capture systemic risk. The crisis shattered the assumption that finance served the real economy. Instead, it appeared that the real economy existed to bail out finance when its bets went wrong. Yet history rarely offers simple villains. The 2008 crisis was not caused by greed alone, or ignorance alone, or policy alone. It was caused by alignment, an alignment of incentives that rewarded short-term gain over long-term resilience. Mortgage brokers were paid to originate loans, not ensure repayment. Banks were paid to package securities, not hold them. Rating agencies were paid by issuers, not investors. Executives were rewarded for return on equity, amplified by leverage. Risk was someone else's problem until it wasn't. In the aftermath, reform arrived but unevenly. Capital requirements were raised, stress tests imposed, derivatives pushed toward clearinghouses. Yet the system did not fundamentally retreat from complexity. Instead, it adapted. Shadow banking evolved. New instruments emerged. Central banks became permanent market participants. The lesson absorbed was not never again, but next time faster and bigger intervention. Perhaps the most profound legacy of 2008 lies in politics. The crisis reshaped public consciousness. Inequality became impossible to ignore. Populism surged on both left and right. Faith in technocratic management weakened. For many, capitalism no longer appeared as a ladder of opportunity, but as a rigged game one where losses were socialized and gains privatized. This perception, whether fully accurate or not, altered the trajectory of democracies around the world. And yet, even in this reckoning, there was a paradox. The same system that nearly destroyed itself proved capable of extraordinary recovery once stabilized. Markets rebounded. Banks regained profitability. Innovation continued. But the memory of fragility lingered, shaping how future crises would be met. When shocks arrived again, whether financial pandemic or geopolitical policymakers acted with speed, learn it in 2008. The crisis became a reference point, a scar that informed every subsequent decision. When I look back on 2008, I do not see a single collapse. I see a convergence of history. The echoes of the Great Depression, the lessons half learned from the dot-com crash, the consequences of deregulation, the power and peril of globalized finance, all met in one moment. The crisis taught us that stability is not a permanent achievement, but a continuous effort, that risk cannot be engineered away if only managed, and that when finance forgets its relationship to society, society eventually reminds it forcefully. This is the final lesson of 2008. Complexity does not equal safety. Innovation does not equal progress. And confidence is not the same as resilience. A financial system can appear strong right up until the moment it breaks. The task, then, is not to eliminate cycles. That is impossible, but to build institutions, incentives, and cultures capable of absorbing shocks without shattering lives. If this story of the crisis clarified something you had wondered about, if a moment or mechanism finally clicked, share what stayed with you. And if you want to keep exploring how past collapses shape present markets and future risks, follow the channel and continue this journey through the repeating patterns of financial history.